Assalamu alaikum, welcome to Study On with Samia Bhatti. In today's video, we are going to learn about financial accounting, and we are going to discuss and understand the definition of financial accounting and its functions. And this is the introductory video which will help all of the business students understand the basic concept of financial accounting in a very easiest way. So let's get started with the definition of financial accounting first. So here's the definition of financial accounting as we start reading it, as financial accounting is a branch of accounting. So first thing to notice over here is that the financial accounting is itself a branch of accounting. Other branches of accounting also exist, but this branch of accounting includes three important things, which are those: the processes of number 1, recording; number 2, summarizing; number 3, reporting all kinds of business transactions. Now the thing to note over here is the kind of or the nature of recording or summarizing or the reporting of any information or data is the business transaction information or business transaction data. As we know that every business performs some kind of transaction, which is maybe the exchange of money, goods, or services to run the business. And the transactions are response of the business that are generated from the activities of the business. Whenever a business performs any kind of activity, the end result are the transactions, which happens is in the form of money or services, and they are exclusive to the basic nature of your business. This is why your business is existing. So as the transactions occur, like we have a lot of money in our business, and that money comes in and goes out of the business. So as a businessman, we need to record this incoming and outgoing of cash, all the payables, all the expenses, so which relates to the first function or the first very important step of the financial accounting definition, which is recording of all those activities which performs the incoming and outgoing of money, the payables, the expenses, the revenues generated from the business. Everything is recorded. The second most important function or the step is summarizing. All of the data which is recorded is now going to be grouped into the specific categories. Like all cash items will go to the cash category, payables, all of the payables will go to the payables category, all of the receivables will come under one shelter, which is called as the receivables category. All kinds of expenses will be recorded in one category of the expense. So this way it becomes very easy for an accountant to come back and check on the records. Okay, if there is any kind of problem occurring into the balances, so they can go and always check easily in the heads of the accounts. So summarizing is very important once the data are recorded. After summarizing the data, it is reported. The third step is reporting, which is very, very important. Reporting to whom? Reporting to the general public, to the stakeholders. The stakeholders can be media, can be general public again, can be board of directors, can be other businesses that have invested, or can be the stockholders who have invested in your business. So this report goes to everybody out there, and it's made mandatory for the businesses to publish their reports on their websites or through their journals that they issue or publish yearly. and this is made mandatory by generally accepted accounting principles, GAAP. So this is the definition of financial accounting, and the report goes in the form of 4 types: income statement, balance sheet, cash flow statement, statement of retained earnings. These 4 statements provide all the significant, relevant, and adequate information about the business's activity for the particular period of time, which is sufficient for any kind of investor or any stakeholder. So this is with the definition of accounting, which is financial accounting, which is a branch of accounting that includes the process of recording, summarizing, and reporting all kinds of business transactions. Now the functions of the financial accounting, as I told you in the previous slide, that there are 3 processes that we have to perform, and these all processes are basically functions themselves, right? Processes. The first one, recording transactions, very initial step of any business, just to maintain an evidence, you may say, or to record, which is like happening in our daily routines naturally. Like we go for grocery shopping, so we maintain our bills record, or if we pay utility bills, so we also maintain those records just to be in line with our all the payments, all the receivables. Then second, summarizing data. This is the function of the financial accounting. Then third is reporting the data. So in recording transactions, we are going to study in a little detail that what we are going to record. Companies, all financial activities are recorded in the books of accounts. You know that the books of accounts are used in accounting. So an accountant use a book where he is going to record the all entries. For example, the entries might start with the entries like journal. You have studied a journal which is maintained by an accounting. So in that, what is going to record? Purchases, sales, and payables or receivables or expenses and profits and everything related to the transactions that happened in that particular cycle, right? So cycle can be monthly, yearly, semi-annually, depends upon the nature of the business. Why we need to record the transactions? Because we need to record and keep a track and a check on everything happening in the business, which is good for the sake of management and to keep an eye and a strict eye, a lion's eye on how much is going in, how much is coming in. So this is about recording transactions. This is the first function of the financial accounting. Then we go to the second function, which is about summarizing the data. All recorded transactions are organized and grouped into categories, like organized according to the same nature of effects in the business. For example, cash goes to the cash section, all kind of cash. Payables goes to the payable sections. Receivables goes to the receivable section, right? Everything goes according to their group categories. This creates an ease on tracking the records, easy in calculation. Maintain record helps in coming back and checking on all the items because it's dedicated in nature. For example, cash incoming and outgoing activities are all recorded under one head named cash with the specific dates. And accounts payable consist of all the paid and unpaid accounts payable record under one head. So it becomes very easy for you to come and check the different people to whom you have a payments to be received, so you can find them under one place, or to whom you have paid all the payables. So this kind of information is provided while summarizing the data. Reporting is all the summarized data used for reporting purposes. Reporting through financial statements. When you use financial statements, for example, when you use income statement, so companies and businesses publish their financial reports, in which you will find four kinds of statements normally. So income statement basically shows the profit and loss of a company, or you can say the revenues and expenses of a company. So it's very clear that any business runs for performing its core activities, and to perform that they incur expenses in order to generate the revenues. So expenses are incurred to generate the profits or revenues. So those all kind of expenses and those all kinds of profit that you have earned by expensing are shown in the income statement. The end result will show you a profit or a loss, which will let you know that next time which expenses to cut and which expenses to carry on. Another financial statement which is going to provide you plenty of information regarding the firm's current assets and current liabilities, and non-current assets and non-current liabilities, and also its capital, which means the ownership. So if you want to know that how much this business owns and how much this business owes, go straight to the balance sheet. So the balance sheet shows a snapshot of company's assets, liabilities, and owner's equity at a specified point in time. Now assets, we know very well that all those things that the business owns. Liabilities, that business owes. And owner's equity is the investment of the owner in the business. So all these things together are shown in the balance sheet, and that is for a specific point in time. So for example, in today's date, if the balance sheet is made, so that information will be only shown for today, not for tomorrow, because every day there are changes occurring in assets and liabilities and owner's equity rapidly. So this is made for a specific point in time, and that shows a company's position and in that particular time only. Well, coming back to the cash flow statement, this is a statement very genuinely used to show cash in and cash out, or say cash inlay and cash outlay in a business. So we know that whatever happens in a business generates either cash in or cash out. These are the two main things happening that results in everything. Like cash services are generated, cash in, and services are taken, cash out. Maybe materials are taken, materials are given. So in all the terminologies, cash in and cash out is happening. So cash flow statement tracks the movement of the cash in the business through operating, investing, and financing activities. There are three kinds of activities in the cash flow statement. So the cash in and cash out is tracked in all of these three activities. And last, statement of retained earnings, whatever the business has retained in the number of years through their profit, which comes from the income statement. Basically, the retained earnings are the profits that you calculate in income statement. They are shown into the capital statement section. Capital statement section, that owner's equity, you add it into the owner's equity. So what are these? They are basically, retained earnings are the residual amount of the business that is considered as a profit of the business. So when you add it into the capital, your capital increases. When you decrease it from the capital decreases. So the thing is like this. So increase or decrease is happening with the retained earnings. So this is also very important statement which helps the investors to understand that if business is having a positive movement in increasing of their capital or the equity, or a negative movement in their equity, so over a particular period of time. So reporting is also very important. So this is in a detail I discussed you the points which are like important functions of the financial accounting: recording transactions, summarizing data, and third is the reporting. So I hope that this lecture was helpful to you, and I hope that the concept is clear. If any questions you can ask. Thank you. Allah Hafiz.